Hi traders, Mark here with Flipside Trading, and welcome to part 2 of our discussion of the options and the common trade structures we're going to use as part of the notification service. Diving right in, let's look at what we're going to talk about today. Basically, it's a concept known as spreads. So with spreads, we're going to go ahead and buy a call and sell a call in some combination as part of the same trade. Or we either buy a put and sell a put in some combination, right? This will be called the spread. The reason we do these spreads is to reduce our risk and increase our probability of success. Don't worry, at the end, we have a handy-dandy reference guide for you so you can track all the different trades and know exactly what we're doing, how we're doing it, and how it affects you as far as your risk control is concerned. So let's dive in a little bit with starting with some review. Okay, remember, option contract, buyer and a seller. Okay, when you buy, you consider long. When you sell, you consider short. We got the leverage piece, right? Each contract controls 100 shares, right? So now, if we want to be bullish, pop quiz. Are we going to buy a call or buy a put? That's right, we're going to buy a call. We're going to buy a call to open that trade. We're going to assume that the underlying instrument is going to increase in price. And then we'll sell that option back with the inverse. So if we bought it to open, we're going to go ahead and sell it to close. All right, now we want to be bearish, right? If we want to be bearish, are we going to buy a put or we go ahead and buy a call? That's right, we're going to go ahead and buy a put. We're going to buy that to open. We're going to assume that the price is going to decrease. As that price decreases, we're going to go ahead and we're going and sell that to close, right? Just the inverse. Okay, that's the fundamentals that we're talking about. So now let's look at how we can apply these together in the form of spreads to produce higher probability, low risk trades. Okay, so what we have here is, right, we're going to call this the bullish debit spread. All right, bullish means we want the stock price to increase. Debit means that we're going to buy it to open. That means our cost or our debit is going to be the risk. We're going to use two different options. So think about this for a second, okay? Here we are. We're down here, and the stock is trading at 50. We think it's going to go ahead. We're bullish. We think that the price is going to go ahead and increase. So the first thing we're going to do is we're going to buy an option right here at the 50 call. We're going to buy that option for $4 a share. All right, that's a debit. Now we think that we have a target in the time frame that we're looking at as per our expiration series around 60. So we're also going to sell a call at $60 for $2 a share. So if we buy one for 4, we sell another for 2, right? Our overall net debit is $2, right? So if we reduce our risk by 50%. We reduced it from $4 a share to $2 a share. Okay. Now, our overall max profit is going to be the width of the spread, i.e., 10 points, 50 to 60. That's a great estimate. The reason why we do this, all right, now not only is our debit smaller, but remember our overall option drivers, right, for price. One of them was time. Remember, when we go ahead and buy this 50 call, it's a depreciating asset. So over time, every single day, we're going to lose a few cents. Now, if we sell this 60 call, we mitigate that because when we sell a call, the inverse is true, right? Time decay is in our favor. We want this to expire worthless. We want the overall price of the option to go down. So what we do is we keep our capital in a much more stable state, and it doesn't depreciate as fast. Now, the disadvantage of this is that our overall max profit is right here at 60. Okay, that means we maintain the benefit as the stock travels here from 50 to 60. But once it reaches 60, right, and goes above here, our profits are capped. Now, don't be discouraged by that. Don't think, why would we do that, right? We're doing that because it increases our probability and reduces our risk, okay? It also maintains our asset price because it's not as depreciating as fast. If we get the market to move from 50 to 60 and capture 10 points, Feel good about it. You're doing better than 95% of all the other traders out there. This is how you make money. You become the house. You sell premium. So we won't do very many of just, straight buying calls or puts. So this is the reason why we do those things, okay? So now, all right, we're going to kind of look at the inverse of that. And let's go ahead and clear and move down to the next thing. Okay, we're going to go bearish, okay? When we talk about bearish, are we going to buy a put or buy a call? Little pop quiz, all right? Bearish, we're going to go ahead and we're going to buy a put. We're going to buy this 50 put. We're going to go ahead and we're going to buy that put for $4, okay? We expect the target price to be 40. We're going to sell that put for $2 a share. Okay, our overall, the cost of the trade is the cost of buying the put, $4, and the premium we take in of selling the put, $2. $2. That's our risk, right? Max profit with the trade, $10. Remember, our risk, our debit is smaller. It's 50% smaller, number one. Number two, we mitigate the asset depreciation, okay? Limitations is that anytime the stock goes over 40, right, as it keeps going, moving past here in this direction, our profits are capped. Minor disadvantage, but definitely out there. That's how we should recognize that. Now we'll take a look at this graphically, because some folks, words make better. Some folks, pictures really help quite a bit. Okay, call debit spread, right? Is this bullish or bearish, right? It's bullish, right? We're buying a call. The underlying instrument we're doing, we're going to go ahead and buy a call, right? We're buying the call over here in this side. We're expecting the price to move in this direction. But once we get to the overall short call price here, our profits are capped. If it goes the other way, we begin to lose money, right? We lose money except our risk, which is the overall debit, right? That's our max risk, so our risk is defined. We're in great shape. Okay, put debit spread. Pop quiz, bullish or bearish? Right, bearish, right? To debit spread, we're buying something. We're buying a put, so we're long. So therefore, as the stock moves this way, we make money until we hit the short strike. And then, right over here, that's our max profit. Stock goes the other way, right? It increases in price. We start losing money, but overall risk is defined by the overall debit, okay? Very simple. Hopefully that helps give you another view of what we're looking at. So now let's take a look at another type of overall vertical spread. Okay. Now we're talking about credit spreads. Okay. Bullish credit spread right here. So for bullish, of course, we expect the stock to increase. Okay. Our overall risk, right? We're going to sell this to open, okay? That's the width of the spread. And we're going to, again, a spread is two different options. So I want you to think about this for a second, all right? So right now, the stock is trading here at 50. We're going to go ahead and we're going to sell a put, right? Sell a put. This is inverse of buying a put. Right? If we buy a put, that's bearish. So we sell a put, we're bullish. The idea here is that we're going to sell this put down here, right? Not where the stock is trading. So now this gives us an advantage, right? This stock can go ahead and trade upwards. We make money. It can stay the same. We make money. And it can drop back all the way to the 45 strike and we still make money, okay? And hugely increases the probability of our success. So let's take a look at the overall math and how we do this. So we're going to go ahead, right? We're going to sell this 45 put. We're going to buy this 40 put for protection. This defines our risk, okay? So if we sell it for $250, okay, we take $250, goes into our account. We buy our protection, our insurance, right? Define the risk. So overall, the net credit into our account is $1.50. That's our max profit. Okay? Having that max profit, we want the options to expire, right? We're going to take advantage of that time decay. In most cases, 0. In some cases, we'll have some other profit targets. Talk about that more in detail later. But this is a very, very high probability trade because we do not need to be exactly right on time and direction. Okay? Remember, we have this cushion. Okay? Now, this high probability, right? It's an inverse risk-reward curve. So we have a very high probability, means small reward. But hey, we're going to be knocking off 5%, right, on these trades left and right as we go forward. All right, one more time, right? We're going to sell this to open, okay? We're going to buy it to close. Since we're selling puts, that's the inverse. That means we're bullish, okay? Master that concept and you're good. Okay, here we go. And we're going to go ahead and talk about the bearish side, okay? Bearish, you want the stock price to decrease, okay? Overall risk be the width of the spread, right? Spread means two different options. Okay, again, let's start down here. Okay, we're at 50. All right. We think the stock is going to fall. We think eventually it's going to move in this direction. But you know, we can make money if the stock falls, if it stays the same, or even if it drops back a little, all the way to the 55 short strike. So to execute this trade, the first thing to do to open it, we're going to sell the 55 call to open. And we're going to take in $2.50 a share. We're then going to define our risk. We're going to buy the 60 call. Right? That's going to cost us money. We buy it right here. So our net debit's $1.50. $1.50, that's what we're looking for. That goes into our account. We get to keep that. That's our max profit. Again, very high probability. We're talking 80-85% in most cases. Okay? Okay, high probability, nice ROI, 5%. We do this again and again and again, and we compound it. And that's how we make great profits over time, okay? This is not a sprint, guys. This is an overall long-term strategy, but very high probability in order to give you guys some discretionary income. All right, again, let's take a look at this graphically. Let's take away all this good little bit writing here. And we'll go ahead and pop it down. Okay, a call credit spread, right? We're selling the call. That's inverse of buying the call, right? Buying the call is bullish. We're selling the call. It's bearish. Okay? So long as our stock price stays below 50, we make max profit right here. We keep everything. Okay? If the stock goes against us and it starts moving higher in this direction, we defined our risk, which is the width of the spread. So we know it is max loss. We won't always take max loss. We'll manage way before it in most cases. But in the event there's a black swan type of deal that occurs and you can't control it, we know what our risk is. Okay, put credit spread. Pop quiz. When I buy a put, am I bearish or bullish? Right? When I buy a put, I'm bearish. So now we're going to sell a put in order to be bullish. That's the overall inverse. We're going to go ahead and sell the put at 50. We expect the stock to move higher or at least lower above the 50. Long as it stays above 50, we keep all the credit we took in. We're also going to sell, we're going to also buy a put for protection, right? It's going to define our risk. That defining our risk is, again, it's going to be our max loss. So that's another way of looking at it in case you're curious, or maybe that helps explain the concept a little better. Now let's take a look at our overall summary of all the trades we're going to do. Okay, very, very simple. Let's take a look. All right. First of all, okay, when we talk about debits, right? These are all our debit spreads. We're directional. right? These are our wealth creation trades. These trades have a higher risk and therefore more reward. All right? They'll make up approximately 30% of our trade portfolio. Complementing that will be our income trades, right? You've seen all the videos and looked at all the blog posts, and we really have hammered those hard, so you should have a pretty good feel for those. But let's take a quick review about what we're talking about in each one of these. Okay? If we go directional, okay, are we going to buy a put or are we going to buy a call? Right, we're going to buy a call. Right, we're going to buy it to open. If we buy it to open, we have to sell it to close. If we're bullish, we want the stock price to go up. Okay, we want the stock price to go down. Are we going to buy a put? Are we going to buy a call? Yeah, we're going to go ahead and buy a put. We're going to buy a put. We're going to be long that position. Right? We're going to go ahead and buy it to open. Since it's a debit, so we bought something, our risk is going to be the cost of the trade. And if we need to exit, or when we exit, we're going to go ahead and we're going to sell it to close. Our vertical spreads, okay, debit spreads, right? Think about bullish. What's our bullish instrument, okay? When we're doing a debit, it means we're buying something. So your bullish instrument when you're buying something is a call, right here. We're going to go ahead and buy it to open. Now we're going to go ahead and we're going to minimize our risk, all right, by reducing the overall debit, and we're going to go ahead and minimize the asset depreciation by selling a call at the target. Okay, that's a spread. We have a combination of two options. We bought one to open, and we're selling a call as well. And when you're overall, since it's a debit, we're going to sell it to close. Okay, kind of the inverse here on the vertical spreads. Okay, hey, we're going to buy something. We want to be short, right? So we're going to buy a put, we're going to buy a call. If we want to be short, go ahead and we're going to buy a put. It's going to be bearish. If we buy it open, we know we have to sell it to close. But we'll go ahead, we're going to reduce our risk, and we're going to reduce our overall asset depreciation by also selling a put at the target. Okay, by doing that, we have a debit, and that net debit is our risk. All right, now we come to the bread and butter. Remember, if we buy a call, we're bullish. So if we go ahead and we sell it to open, that makes us bearish. Okay? Sell it to open, gotta buy it to close. All right, our risk is the width of the spread. So we're going to sell a call, usually at somewhere resistance, and as long as the stock remains below the short strike, we maintain max profit. We're also going to buy a call to define the risk. Okay? Nice and easy. Okay, here we go. If we buy a put, we're bearish, but we're going to go ahead and do the inverse. When we do the inverse, right, we sell it to open. So if we buy a put, that'll make us bullish. Okay? If we sell to open, do the inverse, buy it to close. Right? So if we sell the stock, say if we sell the put at a strike of 40, long as it goes up, stays above 40, we keep the whole credit, put that into our account. But we're also going to buy a put to define the risk. Okay? Where we go ahead and buy that put creates the overall spread distance, and that's our risk. So we define the risk. Okay, guys, hey, that's the summary. Read it over, listen to it more than once. Any questions, give me a call. What we're going to do in the next piece is we're going to demonstrate how you actually construct and execute these trades on the platform. Almost there. Stay patient. Thanks, guys. Catch you on the flip side.